You are being told the economy is fine because the stock market keeps climbing, while people around you quietly lose their jobs, their hours, their savings, and eventually their homes. And here is the part nobody wants to say out loud. The next crisis will not look like the last one, and it will not need to break your bank first in order to break your life. In this video, I am going to connect three things that most people are trained to keep separate. The so-called AI boom that is supposed to create the future. The Federal Reserve interest rate decisions that are supposedly meant to stabilize inflation and employment, and the slow-motion liquidity traps hiding in plain sight across banks, government funding, and markets that look liquid until the day they are not. This is not financial advice, this is financial education, and I am going to be blunt. The system is not designed to distribute prosperity, it is designed to concentrate it. In 2026, you can feel the disconnect in your daily life. You watch companies announce layoffs while their share prices hit new highs. You read that inflation came down, but your weekly grocery bill never went back to 2019. You see interest rates stabilized on paper, yet your rent rises anyway and your landlord acts like wages are optional. And all the while, AI is marketed as a miracle solution, an engine of productivity, a ladder out of wage slavery. But productivity without bargaining power is just a faster way to replace you. Let us start with a question that will make you uncomfortable. If AI is so valuable, why are so many of the jobs vanishing faster than anyone admitted they were coming? Why do you see hiring freezes and restructuring plans from firms that were just months earlier selling you the story of endless growth? And why do the headlines always sound like weather, like something random, while the patterns look engineered? Most people think crises arrive like a storm you can see from far away. That is the first lie. The second lie is that you can protect yourself with the usual playbook. Diversify, buy broadly, wait it out, trust the long term. Here is the third lie, and it is the one that matters. The market does not fall because the future is uncertain. It falls because liquidity disappears, and liquidity is not a feeling. Liquidity is plumbing. When the plumbing clogs, price doesn't go down politely. It jumps down aggressively, and everyone who was sure they were fine becomes a forced seller. Now connect that to AI. AI is not just a product. In 2026, it is a capital story. It is a story that funnels money into a narrow set of beneficiaries: chip makers, cloud providers, and the financial institutions that sit between investors and the cash flow. The average worker does not see that cash flow. The average worker sees a hiring slowdown, a hiring freeze, and then a termination notice. The average retiree sees a retirement plan that never fully recovered from the inflation shock. The average renter sees a housing market that decoupled from wages years ago. And the average household is still told to stay calm because the benchmark index is up. That is why the question about the AI bubble is not just about whether a technology can deliver, it is about whether the financial structure behind it is sustainable. In 2000, the internet bubble ended. In 2008, the liquidity crisis turned into a global financial meltdown. People loved to say those were different eras, different mistakes, different causes. That is technically true and strategically misleading. Because in both cases, the common ingredient was the same. Money flowed in during optimism, and then money vanished when reality became unavoidable. So what happens when you stack an AI bubble on top of a liquidity stress situation? Do you get double pain? Or do you get compound damage? If you think that is dramatic, look at how the Federal Reserve's policy actually lands in your life. When the Fed raises rates, borrowing costs rise. That hits mortgages, hits car loans, hits small business credit, hits variable rate consumer debt. When the Fed cuts rates, people assume the economy is healing automatically. But rate cuts are not a magic spell, they are a tool. If the tool is used when the plumbing is already stressed, it can pour water into a cracked pipe, and you can see the crack. Over the past year, the headlines about rate cuts sounded like relief. Yet labor market data kept weakening. Companies were still cutting. The work that was supposed to expand did not expand. So what gives? One reason is that the labor market is a lagging indicator, and policy takes time. But that is not the full answer anymore. In 2026, the lag is not just a delay, it is a camouflage. Data arrives late because the system wants you busy consuming narratives while the outcome is quietly moving. Then there is the other factor that people do not want to think about. When rates fall, capital does not automatically hire people. Capital finds whatever generates returns most efficiently given the market structure and investor expectations. And in the AI era, returns often come from scaling hardware and software, not scaling headcount. Picture a 34-year-old logistics supervisor named David. He worked his way up from shipping floor rolls. In early 2024, his company hired 2 more coordinators. Then the company announced it was investing heavily in automation and AI routing tools. David was told his job was safe because the system would optimize workflows, not replace people. A month later, the coordinator stopped getting hours. 3 months later, David received a notice that his role was eliminated. The company did not say, "We have stopped needing humans." It said, "We are consolidating positions and improving efficiency." Same language, same tone, and a different outcome. So when you hear the Fed cut rates, you should ask the follow-up nobody asks. Cut rates for what purpose, in which part of the economy, and who captures the upside? Now let's talk about the uncomfortable celebrity in this story. Warren Buffett. People worship Buffett because he is the opposite of what they fear. He looks calm, he looks patient, he looks like he plays a different game than the rest of Wall Street. And because he is famous, people assume his actions reveal truth. But fame does not guarantee clarity. It only guarantees attention. There is a reason Buffett has sat on an enormous amount of cash. In many media conversations, it becomes a comforting myth that he is just waiting for the right moment, or that he is being responsible, or that he is preserving wealth for the next generation. Let's strip the myth away. If you hold massive cash for years, inflation still attacks your purchasing power. Cash is not neutral. Cash is a silent loss. So holding cash at this scale requires a belief that the opportunity cost is worth it. In other words, someone who is holding hundreds of billions of dollars in cash is not doing it casually. They are doing it because they see a risk that is larger than the opportunity cost. And yes, people will say, Buffett never shorted the market, as if that makes him safe to misunderstand. Here is what matters about shorting. It is not magic. It is not necessarily some Hollywood-style maneuver with borrowed shares and chaos. The essence is simple. Sell high and buy low. Whether you do it with formal short positions or whether you do it by selling assets and piling up cash, the economic shape can look similar. When the market is at exuberant highs, a person who sells into strength is doing the first step. When the market breaks and a person who holds cash buys at lower prices is doing the second step. That is the skeleton of market timing, even if you never say the word short. And Buffett has reportedly built that skeleton repeatedly across decades. He sold in the tech era before the internet crash. He distrusted certain financial structures before the global financial crisis. And in the present cycle, his cash pile has grown massively while he has continued to reduce risk. So the cash is not just money, it is a weapon of patience. Now, you might respond with the classic defense. But this time it is different. This time it is AI. This is where people get trapped. They think a new technology rewrites the rules of finance. It does not. Markets can price stories faster than they can price fundamentals. AI can be real and still be overhyped in the way it is monetized. A technology can deliver breakthroughs and still fail to justify the valuation multiples that investors have stacked on top of it. And then, if liquidity conditions tighten, the most overvalued narratives suffer first. In 2026, we are seeing valuation gravity combined with labor disruption. You can watch it happen in real time, companies investing tens of billions into AI compute while simultaneously announcing layoffs or hiring freezes for roles that are not directly tied to AI profit centers. That is the pattern you were not trained to interpret. You were trained to believe that technology creates jobs. It can, but in a capitalist system, technology can also concentrate bargaining power and reduce labor demand in the short term. And if that labor demand disappears, consumer spending contracts. That is how a boom turns into a fragility. Now let's move to the second major piece of the puzzle. What happens when the Federal Reserve lowers rates while the economy still feels sick? There is a specific economic term for this feeling of contradiction: policy transmission failure. In plain language, it means the rate cut does not reach the part of the economy that needs it most, or it reaches it but does not produce the intended results. In a healthy cycle, lower rates reduce borrowing costs and stimulate hiring. Businesses see the future more clearly, invest, and expand. Workers get more job opportunities and consumption rises. But if your economy is structurally misallocated, lower rates can instead feed asset prices and corporate balance sheets without restoring employment. That is when you get the weird world you are living in. Stock indices grind upward while ordinary people are stuck in declining purchasing power. This is not just theory. You can observe it through labor announcements. Even if headline employment statistics move slowly, mass layoffs show up quickly in company statements and third-party trackers. 1 month of dramatic layoffs can tell you more about reality than a quarterly government report. And by 2026, many households are experiencing a version of that. They get hit by job cuts before the data catches up. So when the Fed cuts rates, the wrong question is, will stocks go up? The right question is, where does the new liquidity go? Does it go into factories that hire workers, or does it go into compute and capital equipment that replaces workflows? Does it go into local small businesses that employ people, or does it go into financial engineering and share buybacks that reward shareholders? And if it goes into AI, does it go into AI that creates new jobs, or AI that automates away your job category while the corporate winners capture the profit? The answer emerging across multiple sectors is not comforting for workers. It looks like capital is flowing toward the competitive advantage of automation and away from labor-intensive expansion. Now here is the cliffhanger, the part that turns economic disagreement into something darker. If AI is not just a technology but a financial funnel, and if the funnel is fed by liquidity, then what happens when liquidity starts to retreat? That is where the AI bubble becomes less about robots and more about money moving through fragile channels. Because there is another plumbing system underneath all of this, and it is not talked about in motivational finance clips. It is the government debt and short-term funding cycle. In modern markets, a huge portion of stability depends on the ability to roll over short-term obligations. Governments, banks, funds, and leveraged investors rely on continuous refinancing. That is how the calendar works. Mature a debt, issue new debt, and keep the machine running. But when you tighten funding conditions, or when cash gets locked, rollover risk spikes. Now you might think the government can always borrow, it prints the currency. That is partially true and strategically misleading. A government can borrow, but borrowing is still constrained by investor appetite, by market liquidity, and by the rate environment. And most importantly, a government does not just need to borrow, it needs to borrow in a way that does not trigger a cascading liquidity panic. If the rollover is constantly threatened, then the government has to find new ways to bridge the gap. And bridging often creates new stress elsewhere. In 2026, you have seen episodes where government operations slowed down, creating timing problems in payments. When large payments get delayed, money is not just delayed in one place, it disappears from cash flow across supply chains. A company that was waiting for government funds cannot pay its own obligations. Then its bank relationship tightens. Then suppliers get squeezed. Then workers get laid off. That is not conspiracy. That is chain reaction economics. Now imagine that chain reaction is happening while the financial system is also watching for AI-related valuation stress, and while banks are operating with reduced emergency reserves. Then the question becomes, who has liquidity when the calendar hits? When liquidity evaporates, the market stops caring about the story. It cares about settlement, and settlement is ruthless. Now let's talk about the banking side without pretending banks are all doomed. The truth is more technical and more terrifying. Banks can survive solvency problems longer than people think because they can use central bank facilities and have reserve requirements that act like safety rails. But safety rails are not infinite. If reserves are near thresholds, and if short-term liquidity lines shrink, then the system's capacity to cushion shocks decreases. Think of a hospital with limited oxygen tanks. It can treat many patients under normal conditions. But if a shock happens and you run through the supply of oxygen quickly, you do not need a new pandemic. You just need one bad hour. So, when people say the economy will be fine because the central bank is there, they miss that the central bank can only do what it is allowed to do and what liquidity markets can absorb. In a true liquidity crisis, even large institutions can scramble for cash at the same time, and that scramble is the spark. And now we return to the AI bubble. If AI capital is tied into leveraged finance and short-term funding, and if some part of the system forces assets to be sold quickly to meet margin calls or redemption needs, then the AI narrative gets its valuation compressed at the worst possible time. This can happen even if AI is still improving technically. The collapse would be financial, not technological. Now, you might ask, okay, but what about crypto? Didn't crypto promise freedom from banks? Crypto promised that the system would bypass traditional financial institutions, and for a while, it almost did. But in 2026, crypto has matured in the most predictable way possible. Institutions got involved. Regulations shaped it. The winners became the ones with market access, liquidity access, and compliance infrastructure. Stablecoins became a critical piece of the ecosystem. And stablecoins are not free from the banking problem. They are tied to collateral and reserves that ultimately connect to the traditional financial system. In stress events, stablecoins can create a strange inversion. Retail users imagine stablecoins shield them from traditional banks. But if stablecoins are minted and redeemed based on market liquidity and collateral value, then their stability can depend on short-term instruments. And if those short-term instruments are under pressure, stablecoin players can become forced sellers. So instead of crypto being outside the system, crypto can become another lever amplifying the same liquidity cycle. When collateral gets hit, people sell to get cash. When cash is needed, assets must be sold quickly. When assets are sold quickly, prices drop. When prices drop, collateral requirements can tighten, and the loop accelerates. Now you can see why the AI boom narrative could be just one layer above a broader liquidity stress event. AI attracts capital and expands balance sheets. Leveraged positions multiply. Then liquidity stress forces deleveraging. You do not need fraud, you need mechanics, and mechanics do not care about your optimism. Here is where it gets personal, and I am going to be honest about why. Most people are not poor because they are lazy or stupid. You are not lazy. You are not stupid. You are just living inside a system that does not reward patience for the majority. It rewards extraction for the winners. When your wages do not keep up with inflation, you are not doing something wrong every day. The system is transferring value. When housing prices rise faster than incomes, that is not a personal failure. That is market power combined with supply constraints and speculative demand. When your retirement is underfunded because pension promises were built on assumptions that interest rates would stay favorable and markets would keep behaving, that is not your mistake. But you still pay the price. In the last decade, wealth inequality accelerated. The top 1% owns more than ever in many Western countries. That wealth is not just wealth, it is access to capital markets, access to tax optimization strategies, access to borrowing against assets, and access to speed. When markets drop, the wealthy do not just panic. They buy selectively, they reallocate, they hire for bargain prices, they refinance at better terms. Meanwhile, you are stuck with your job schedule, your rent contract, your medical bills, and your retirement plan that cannot be diversified fast enough when a crisis hits. That is why the stock market reaching highs while life feels worse is not random. It is a redistribution pattern. Markets are not a mirror of everyone's well-being. They are a scoreboard of which groups control the flow of capital. And if AI is a new capital magnet, then the scoreboard can keep rising even while the majority is drowning. Now, let's talk about housing in 2026, because housing is where finance becomes human pain. Housing detached from wages years ago. Even if inflation stabilized, home prices and rents did not return to reality. In the United States, the United Kingdom, Canada, Australia, and parts of Europe, the affordability crisis looks permanent to anyone watching. Millennials and Gen Z are not choosing to rent. They are stuck. So when rates fall slightly, housing does not magically become affordable again. It might even get worse as investors anticipate rate relief and bid up property prices. Meanwhile, wages remain slow and layoffs become structural because AI reduces labor demand. If you are renting, you experience a different inflation. You experience it through monthly cash outflow, not through consumer price indexes. Your purchasing power is consumed by rent growth, insurance hikes, and utilities. Climate-driven economic disruptions make it worse. In many regions, insurance availability has collapsed or premiums skyrocketed. People are relocating. Migration costs rise. Families move, and every move is a financial reset toward instability. When you add job loss risk from AI disruption on top of housing instability, the average household becomes fragile. Fragile households do not hold cash. They spend whatever they can. They cannot delay consumption. They cannot build an emergency fund quickly enough. And in a downturn, those households are the ones that get forced into selling assets, falling behind on payments, and taking expensive credit to survive. That is how liquidity crises become personal disasters. Now you might think, so what does this have to do with Buffett and shorting? It has everything to do with